Okay, what's going on, everyone? This is going to be the first video for the Chapter 1 problems. We're going to divide this into two videos. You could do it in one. There's not that much going on here, but I like to chunk it out and make it a little bit more reasonable. So we're going to look at the first two problems here, BE 1-1, brief exercise 1-1, and exercise 1-1. Looking at this, right, accrual accounting, if we look at just kind of the stem here, right, can you please calculate accrual net income for the year? So if you look at the end first, that can prime you for the beginning. I've built this out over here, right, for accrual. It's revenues minus expenses, get you your net income. Generally, your revenues are going to be when you earn them. Your expenses are going to be when you incur them. And then the difference will be net income. It could be theoretically net loss. So we're trying to read through these facts and kind of pluck out the revenues and expenses. And it's not necessarily going to be, as we discussed, when we get the cash or we spend the cash. That would be the cash basis. All right, so let's read through it and then we'll kind of dissect it, right? It says cash flows during the first year of operations were as follows. We collected cash from customers, 340, so that must have been cash sales. Here's the goods and services, they pay us in cash. We paid 40 in rent. We paid salaries of 120. It looks like the salaries actually reflected the work that was done during the year. And then we paid 50 in utilities, right? So that's just purely a cash perspective on there. It says, in addition, you determine that the customers owed the company 60,000 at the end of the year. So that must have been sales on account, right? We're not going to pay you now, we'll pay you later, but we gave them the goods or services. We must have earned that amount. There were no bad debt expenses. And it looks like we've also owed the gas and electric company 2,000 at year end. And the rent, right, was for a 2-year period. Okay, so we have a lot of different things here. Let's just start with the revenues first, right? We'll make the revenues, let's just say green on there. We know that obviously it's going to be the cash we collect from customers. This must have been in-person sales that we earn the revenue and they just happen to pay us in cash. We also have the sales on account, right? So for here, right, we will have the 340 plus the 60,000. We're looking at 400,000 of accrual basis revenues. Next, let's look at the expenses, right? We'll just make these yellow. We know that it's going to be something like rent, salaries, and then utilities, right? Just based off the facts. So there's rent, there's salaries, and there's utilities. Let's focus on them one at a time. We know that we paid 40,000 in cash, but here's the deal, right? That's for a 2-year period. So that was prepaid rent, of which 20 we used in the current year and 20 we'll use in the next year, right? So this is going to be equal to the 40,000 we paid divided by 2. Okay? Likewise, let's look at salaries here. They tell us the services were rendered during the year. In other words, the employees worked during the year and we paid them during the year. We can trust that number, right? The 120,000, that's good. The utilities, though, we do have to kind of think about it, right? It was year one, so whatever we paid, we had to have used. And then we also must have accrued or used an additional 2,000 on there, but we're only going to pay that next year. We don't look at how much we paid, we looked at how much we used. In this case, right, we must have used the 50,000 and the 2,000. We now have our information, right? We can do equals our revenues minus our expenses, right? So one kind of variation is just, literally do positives and then minuses. We're looking at 208,000 of net income. Okay? Nothing too bad on that one. Let's move to exercise 1-1. Okay? I have built out, again, some of this over here, so feel free to pause and build it out in Excel or do it on your notebook or just watch, whatever is good for you. They tell us here, right, there's going to be 3 asks, right? They're giving us a bunch of information for year 1 and year 2. Can you please calculate the net operating cash flows for those years, right? So we're going to do cash basis. They then want us to do it using accrual, right? So we'll then kind of rerun the analysis through accrual. And then finally here, we're going to try to track those receivables under accrual basis accounting, okay? So let's start here with cash, right? We'll just make this one green, right? Because cash is green. Let's read the facts now. Listed below are several transactions that took place for a law firm. We have year 1, we have year 2. We have the amounts we billed to clients for services that we've rendered, and then we have the actual cash that we collect. We care about the cash we collect, right? It's going to be our cash in or your cash receipts, right? So this 160 and 190, that's good stuff, right? We can use that right over here. That's the functional equivalent of our revenues, right? Because the rule for cash basis is cash in, we have a cash receipt. Cash out, we have a cash expenditure on there. So we've done our cash in, that's great, nothing too hard. Now we have our cash out, right? Cash disbursements on here. So it looks like salaries, utilities, and insurance expense. So we can put that in, salaries, utilities, insurance expense, and I'll just copy that down here. We'll see it again, and maybe I'll move it over to kind of keep it a little bit separate on there. Okay. So here, again, it's as easy as it gets, right? They tell us how much we paid in cash, right? What were the outflows? So we can use those numbers, right? 90,000. And I don't know, let's just try a different technique. We'll make these negatives just to indicate that it's a cash outflow. And again, we can do the same thing for year 2. In this way, right, our bottom line, right, like Stone Cold Steve Austin, that's the bottom line, right? Here, the bottom line we land at for the cash basis is the net operating cash flow. So we can just do, right, equals really just the sum of all of those guys, right? The positive and the negatives. Hey, we're looking at negative 20,000 on there. We can do the same thing for year 2, okay? So negative 20 and 50. Cash basis, all we do is cash in, cash out. As easy as it gets. Now we're going to rerun the analysis through the accrual basis. So we're going to have revenues and expenses, not cash in, cash out, right? And we're not going to have net operating cash flows. We're going to have net income. In this way, right? I don't know. Let's just make this one yellow, right? We're going to look not necessarily to the cash we collected, but we're going to look at the amount we billed clients, because that reflects what we've actually earned on there. Some of what we billed we've collected, right? But some of it we'll collect later. We're not looking at the cash inflow. We're looking at what we've earned on there. So we can use these numbers, right? 170 and 220. Hey, nothing too bad there, right? I mean, this isn't bad if you just break it out one step at a time, but we're gonna have to make some adjustments to these, cash disbursements, because the rule isn't cash out. The rule is, did we incur the expense? So let's first look at some of these. Some will be good, right? We'll be able to use, but some we're gonna have to modify. Salaries for employees. Hey, that was for work that they did during the year. We must have incurred the expense during the year. We can use these numbers, right? Just like last time. That's good stuff. No modifications here. And I don't know, let's just make these negative again, just to be consistent with above. There's different conventions you can use on this. As long as you're getting to the bottom line on there, that's all that matters. If you're doing the Connect homework, they might have a different convention on there. In any event, right, that was salaries, easy enough. The utilities, right, we have to read a little bit more. They tell us, right, here's the utilities. We incurred 35 in year one, but we do know, right, in total, there were 70, right, if you look at the 30 and the 40. So if we did 35 in year one and there were 70 total, then the remaining 35 we must have incurred in year two. So it's a little bit like a puzzle, right? You have to kind of analyze it and say what's going on here. But we'll do negative 35,000, negative 35,000. The insurance policy, right? If we look at this, I'm just going to kind of clear the board over here to make it a little bit cleaner to see. Yes, it was for $60,000, but that was for a 3-year period, right? So we'll do 20 in year one, 20 in year two, and 20 in year three. For purposes of our example, we just care about year one and year two, right? So negative 20, negative 20. Oh, didn't enter that in all the way. And then we can just sum this, right? Equals sum equals sum. So we're looking and we're landing at 25,000 and 65,000. Just to show you, right, if you use like, why the accrual basis is more accurate, or at least how these differ, right? Under the cash basis, it looked like we were at a loss in year one, but under the accrual basis, hey, we were actually positive on there. We were, making money and profitable. The next thing they tell us is, can you please figure out the amount of receivables that they would show in year one and year two on the balance sheet using the accrual method? So that's what I've built out down here, right? We'll learn, you should know the basics of T accounts, but they really follow that base formula: beginning plus additions minus subtractions gets you your ending. Every T account has their own kind of BASE, right? So for accounts receivable, it's what you started with plus what you build on account minus what you collected gives you your ending. It rolls forward every year. These balance sheet accounts are permanent accounts. They roll forward such that last year's ending is this year's beginning. So let's look at this, right? They told us up here, right, in the facts that, let's see here, during the first 2 years of operation. So in year one, we're a brand new business, right? So if we literally just started, our beginning accounts receivables are going to be 0. They tell us that we billed 170, but we collected 160, right? So 170 minus 160. If we run the math on that, at the end of year one, our accounts receivable balance should be 10, right? That amount carries down and becomes our year two beginning balance, right? It's kind of like if I came up to you at New Year's at 11:59 and I was like, hey, how much money do you have in your pocket? And you're like, well, I got $20. Then the New Year's ball strikes or whatever, and there's all the parade and all that fun stuff. Then I come up to you at like 12:01 and I'm like, how much money do you have in your wallet? And you're like, $20, right? Last year's ending, how much you had at the end of last year, is what you're going to start with for this year, right? So last year's ending is this year's beginning. We can just even straight up link that, okay? We can then use the facts, right? In year two, we billed 220, but we collected 190, right? 220, we collected 190. Sum these guys, right? Hey, at the end of year two, our account receivable balance will be 40 on there. 40,000, 10,000, right? I just cut out some of the zeros. Nothing too bad. Okay, so we will finish this lecture here because we're done through the first 2 problems. In the future, right, the other chapters, these problem videos will be about a half hour each, but chapter 1 is just a review. So we'll pause it here and we will see you guys in the next video.